Today, private banks wield immense power over our economy. They control the flow of money through lending and borrowing. This system is inherently flawed. It concentrates power in the hands of a few and makes the economy vulnerable to instability. We need a new approach. The current system relies on central banks manipulating interest rates. These actions indirectly influence bank lending and the money supply. This approach is slow and often ineffective. It can exacerbate economic downturns and fuel inflation. The 2008 financial crisis exposed the fragility of this system. Private banks, driven by profit, engaged in risky lending practices. This led to a global recession. It is time to rethink who controls our monetary policy. State governments are uniquely positioned to execute monetary policy. They are accountable to the people and have a deep understanding of local economic needs. By empowering states, we can create a more stable and equitable economy. Imagine a system where state governments receive capital injections directly from the central bank. This would bypass the private banking system. States could then invest in infrastructure, education, and other essential services. This approach would allow for targeted economic stimulus. It would ensure that money flows to the areas that need it most. It would also reduce the likelihood of speculative bubbles and reckless lending. State endowments, with their long-term investment horizons, could serve as primary dealers in this new system. They would purchase government bonds directly from the central bank. This would provide states with the capital they need to fund their programs. Currently, private banks act as primary dealers. This gives them an unfair advantage in accessing cheap credit. By shifting this role to state endowments, we can level the playing field. This change would also reduce the risk of moral hazard. Private banks, knowing they are too big to fail, may take on excessive risk. State endowments, focused on long-term stability, would act more responsibly. Direct capital injections into state governments would have a profound impact on economic stability. States could respond quickly to economic downturns. They could invest in job creation and infrastructure projects. This would provide immediate relief to citizens. This approach would also reduce the need for complex and often ineffective monetary policy tools. Instead of relying on interest rate manipulation, the central bank could directly control the money supply. This would lead to more predictable and stable economic growth. Furthermore, by investing in education, healthcare, and other essential services, states could improve the long-term productivity of their citizens. This would create a virtuous cycle of economic growth and social progress. Shifting monetary policy control to state governments offers enduring benefits. It empowers local communities. It promotes economic stability. It fosters a more just and equitable society. By removing the profit motive from monetary policy, we can create a system that prioritizes the needs of the people. State governments, accountable to their citizens, are best positioned to make these critical decisions. This new approach is not without its challenges. It requires a fundamental shift in our thinking about money and governance. However, the potential rewards, a more stable, equitable, and prosperous future for all, are well worth the effort.